I'm Darryl, Darryl King. I'm the underwriting director here, and a lot of you guys I know, I've been able to chat with you before, but I wanted to take this impromptu opportunity to just go over some of the income related things that I was, that we had training last week in Santa Ana, as you can see in the upper left hand corner of this page. It was lender training. Very, very informative. It refortified a lot of things that we knew. But I will tell you, I was doing a lot of networking. I was speaking with the head of collateral for the Santa Ana Hot. And he was a gentleman who's seasoned, been around for a while. And he said his opinion is that with the way that rates and stuff have been going, that pretty soon FHA is going to be the main show, if not already. Could possibly be the only show in town in the near future. Thankfully, we were able to secure our full delegation with FHA through test cases approved, and we are now totally delegated with FHA, so we can do all of these loans in house. So that was it was a pretty great feat. It was kind of taxing, but it was a challenge that we not only faced, but we conquered. So I'm pretty proud of the team that I was able to work with to get that done. So now what I'm going to talk about today are some of the nuances of income as it pertains to FHA loans. Now, a lot of these things you guys may know, and some of this information might be new to you. So I am going to leave some time at the end so I can answer some questions. But I will encourage you guys to, if you have any questions, I am extremely accessible. Send me an email with your question, and I will answer to everyone so that everyone gets the opportunity to learn from that. So without further ado, I'm going to go through. I cut out some pages of the deck that we went through as it pertains to income today. Now it's so many different facets to the training. I am going to use this going forward, that training deck, to reiterate some of the things we already knew and to introduce a few things we may not have. But first and foremost, this is the key. For all employment-related income, the mortgagee must verify the borrower's most recent 2 years of employment and income and document the current employment using either traditional or alternative method and past employment as applicable. What does that mean? Obviously, it means a detailed VOE. Now, as a sidebar, when you get a handwritten VOE, make sure that if they get any overtime or bonus, that box to the right, I believe is box 13. I'm not 100% sure because I don't have an example of, but make sure that box is checked yes. Now, what I did learn is that if it is not checked at all, then we can consider it a yes. But if it is checked no, for instance, if bonus or overtime is checked no, and you present bonus overtime, I cannot use it. So that's just reiteration to make sure that we're all on the same page as that. Okay, now let me see what's the best way to do it. Let me see. Okay. All right. So now you see it says total and manual. Total just means DU. We're just going by AUS. And of course, manual means a manual underwrite. Parameters of manual underwriting is relegated to the debt ratios. And I can send you guys the ratio parameters. But if you can Google it, you can Google FHA manual underwriting rules, and it will break it down for you. If using alternative documentation, the mortgagee would be us as the lender, obtain copies of the most recent pay stub that shows year-to-date earnings and copies of the W-2 for the previous 2 years, and document current employment. Of course, this is what we have to do with the VVOE to make sure at the end that they are still employed. Re-verification must be complete within 10 days. That's boilerplate. And that's something that your operations partner will do. Now, there are some exceptions because of the lingering COVID-19 effects. So if in fact, instead of me going through all of the COVID-19 related situations, I'm going to skip over those. But if in fact your borrower was affected and their earnings over the past 2 years was affected by COVID-19, just know that FHA has baked in provisions that will take that under consideration. And just for example, for employees who are paid hourly, whose hours vary, the mortgagee must calculate the effective income by using the lesser of the average income in accordance with the hourly standard section above, which is what we're talking about, and the average income earned since COVID-19 related economic event. Again, this gets a little bit involved, but I haven't seen very many, if at all, that currently that are effective has a lingering effect from COVID. But whenever COVID is an issue, we will definitely take that under consideration. Now, this part right here is something that is not often understood, but I want to make sure that we're crystal on this. For employees with overtime bonus or tip income, the mortgagee must calculate the effective income by using the lesser of the average overtime bonus and tip income over the previous 2 years, or if less than 2 years, the length of time the overtime bonus or tip income has been earned, or the average overtime bonus or tip income earned over the previous year. So the key to know is any overtime bonus or tip income, whatever they've made year to date, does not enter into the calculation. Now, we do need to see that they are still earning it, but when calculating the income, it's the average of the previous 2 years. This is something that I have to explain, a lot of times when getting file submissions in. Anything other than base income is calculated by the average of the previous 2 years. Or if the previous year is less than the prior, then it's the average of that, the lesser, which is the previous year. Okay, so please keep that in mind. That's probably one of the most important things about the income calculation that we run up against quite often in underwriting. Now, I can consider seasonal employment as effective income if the borrower has worked in the same line of seasonal work the past 2 years and is reasonably likely to be rehired for the next season. Now, tax preparers, especially people who work in the tax field, who, every year during the tax period, that's when they're working and earning income. If we have a history of them doing that, then we can use it. Now, I can consider unemployment as effective income for those with effective seasonal employment income. So if they just work seasonally and they get unemployment after that, then we can consider that income. Now, but again, it has to be something that we show a history of. The mortgagee may use commission income if the borrower has earned that income at least 1 year in the same or similar line of work, and it is reasonably likely to continue. So I usually look at commission income as I do what I just categorize as anything other than base income. So that calculation is the same. Now, I can't just use commission income for year to date. I have to prove that they have been receiving that for at least 1 year and in that similar line of work. So keep it in mind, it's always an average if it's not base. Now, here it is. The same thing. It's the average of commission income earned over the previous 2 years of commission. Income earned for 2 years or more, the length of time commission income has been earned. And if less than 2 years, has been earned if less than 2 years, or the average income earned over the previous year. Same thing as before. If they earn more in 22 than they did in, they earned more in 21 than they did in 22, then it's 1/12 of 22. So it's whichever is lesser. Self-employment, of course, is when they own 25% or greater. Mortgagee may consider self-employment income if the borrower has been self-employed for at least 2 years. This is something that has come up a couple of times. When you have a borrower who is providing 1120s, 1065s, up in the right corner of that schedule, it'll say how long they've been self-employed. So I don't want us to say we get a letter from the CPA saying that they've been doing this for 7 years, and then the schedule says they've only been doing it for 2. So just be sure that you inspect what you expect when it comes to verifying the length of self-employment. Same stands true for Schedule C. If anything in the file shows that they've been self-employed for less than 2 years, then we definitely need to make sure that we can justify using that income. So please keep your third eye out for the length of time of self-employment, checking your schedules, anything as far as the dates go that will allude to them just beginning self-employment. We want to be cognizant of that. And if you provide a letter from the CPA saying that they've been self-employed for 7 years, by God, that schedule needs to say the same or greater. If income from a business shows a decline of effective income of 20% or more, the mortgagee must downgrade that transaction to a refer and manually underwrite. So when you're looking at, it's quite simple. If you look at 22, it's 20% or more less than 21, then that has to be manually downgraded. And that's where those manual underwriting rules come into play. Manual underwriting is not, it's not necessarily a negative thing. It just means that I have to look at, or my underwriting team, we have to look at each document as if AUS did not exist. So we have to go through and manually calculate income. I've got to go through and check, all the provisions that you're used to seeing on your total scorecard or your AUS. I have to look at it manually. But more importantly, your debt ratios are restricted in manual, whereas you don't have as many in the regular, what we would call the total. Of course, this goes with the stability, and again, this is where the COVID-related rules come into play. The borrower must have an aggregate 2-year self-employment history before and after the COVID-related economic event. That's huge. If the borrower has an aggregate self-employment between 1 and 2 years before or after COVID, I can consider the income as effective if the borrower has previously employed in the same line of work to which they are now self-employed. So that happens a lot, and that's pretty cut and dry. The key is not necessarily not just that they've been self-employed for 2 years prior to, but if they've been in the same line of work and then they branched out on their own, then COVID hit, and now we're coming for a mortgage. I can look at that. Mortgagee may consider income as stable after a 20% reduction if I can document the reduction in income as a result of COVID-19 related economic event, and the borrower can demonstrate that the income has been stable or increasing for a minimum of 6 months, and the borrower qualifies utilizing the reduced income. Now, how do we prove that for a minimum of 6 months? Of course, we want an audited P&L. If it's a sole proprietor or Schedule C, we don't need a balance sheet. But if it is a S Corp or a corporation, I need the balance sheet as well. Another form of proof is business bank statements. I have an income worksheet that I use, and I would, I'll share with anyone who needs it. But it has a caveat for those situations where we are using bank statements, because essentially whatever the P&L says their monthly income is, I need to show business deposits that support that income. So, for instance, if you say it's $10,000 a month based on the P&L, I need to see $10,000 or more of business-related deposits going into the account that's used to manage the business funds. Mortgagee must obtain completed individual business tax returns for the most recent 2 years. This is pretty common, and if necessary, this isn't mandatory really, a credit report for all corporations and S corporations. We don't use a lot of business credit reports, and there's different triggers that would require that, but we haven't in my history with iCore, I haven't seen that triggered.
Well, what are the triggers?
As far as the triggers would be, if in fact they're in the business has shown substantial losses, they have any judgments, there's any legal actions pending against them, and there's those sorts of things.
Okay.
And if you show any deductions on the returns, if there's in the schedule and they show anything that alludes to any type of negative, I don't say activity, but again, judgments or they're paying attorney's fees and things of that nature. All right, here's the exceptions for the COVID related event, but I'll just skip down to the bottom part right here. Like I said, an audited P&L statement, reporting business revenue, expenses, and net income. And then an unaudited P&L statement signed by the bar, expenses and net income, including most recent and preceding the case assignment month. And there we go with those 3 of the most recent business bank statements, no older than the latest 3 months, represented on the year-to-date P&L. Monthly deposits on the business bank statements must support the earnings of the unaudited year-to-date P&L, as I was just stating, as an alternate method.
Darryl, I have a question for you.
Yes.
We come across clients that are self-employed Schedule C,
Mm-hmm.
and they don't have a actual business
Right.
account. Like it's just their personal account and use it for business purposes.
Right. So if in fact it's a Schedule C and they use their personal account for business cases, like I was saying before, I need to be able to identify deposits in those accounts that are based on the business income. So as long as there's large deposits or whatever the deposits are that are based on the business income, then we can identify them. Not a lot of times you see people get paid via Zelle and all of these things.
Yeah.
I can't take that at face value. We need to try and support that. Now, a lot of times it's hard to do it, but with FHA, one of the I don't want to call it the flexibility that we have is that if we can explain it and it makes sense, then I can use it. But keep in mind, if I'm just getting, counter deposits and things of that nature, it has to be indicative of the type of business. But that's how you do if they are running their business through their personal accounts. And that happens all the time.
I have another question for you.
Yes.
Based on the meeting that you had, was the Zelle and Venmo deposits addressed in any way, form, or shape that can help us? Because a lot of people are using that now.
Right.
Everybody's using it.
That exactly, and that's what I was just saying. We have to put together a story to make sure, and it's going to depend on the type of business. The question was there any direction on Zelle and Venmo and those sorts of things? It has to make sense. If we have a person, for instance, a landscaper. Landscapers, I know I pay mine through Venmo all the time, but it has got to be indicative of the type of business that it is, and that's easier to explain on a Schedule C borrower than not, because again, I can't say that it's not business related. I just need to identify it as such, and then put some sort of documentation, whether it's an affidavit / LOE or some sort of a couple of invoices. Invoices is really the best way to substantiate Venmo and Zelle payments. But if in fact you don't, in lieu of invoices, let's just put together a picture that we can all digest. And I'm working with you 100%. So we'll talk about it, and I'll make sure that we put something together that's acceptable.
Thank you.
Okay, no problem. All right, so mortgagee must analyze the tax return, determine gross self-employment, of course. Requirements are found in analyze. This is just for us internally. Mortgagee must calculate by using lesser of course, it's always the previous 2 years, or if the previous if 22 was less than 21, then it's 1/12 of 22. So, and that's normal calculations. That's nothing that should be new. P&L statements, mortgagee, I have to get the P&L statement and balance more than a calendar quarter has elapsed since the date of the most recent calendar or fiscal year end tax period. The balance sheet is not required on Schedule C borrowers. Okay, so when it comes to the balance sheets and whatnot, you do want to make sure that you are cognizant of the time, in the year that we're getting, that we're using those tax returns. So a good rule of thumb is, and I'm always going to condition for a balance sheet on non-Schedule C self-employed borrowers. That way, if I always ask for it, then we won't come in the 12th hour and have to get it, because especially during the later part of the year, we are going to need that. Gaps in employment. This is something that's very important. Gaps in employment of 6 months or more, or an extended absence, family leave or whatever. I may consider the borrower's current income if they can verify that he's been employed in that current line of work for 6 months at the time of the case of assignment, and a 2-year work history to the absence from employment. Hey guys, you need to mute your phones. Please mute your phones. Please. Again, a 2-year work history prior to the absence of employment using the standard or alternative employment verification. So if there's a gap, we still need to show 2 years prior to that gap. We can't include the gap in the 2-year history, of course. And gaps, here it is, it's VOE, of course. That's the best way. For self-employed borrowers with
the following documents for always to verify and verification of employment, VOE, identifying the temporary loss of employment, temporary loss of income, temporary loss of house, self-employment, income. For always with gaps in self-employment, reduction in income or reduction in hours.
Enrique, I think you need to mute your line. We can hear you.
Okay.
Thank you. All right. He was reading. I was wondering if anyone was following with him. For borrowers with gap self-employment, a reduction in income or reduction in hours due to COVID-related economic event, I may exclude the months where the business was closed or income was reduced when calculating effective income. So again, this is one of those COVID-related exceptions. I haven't seen a lot of them, but in the event that they exist, I want to make sure that we are utilizing that.
That's good to know. That's good.
Absolutely. For borrowers returning to work before or at the time of the first mortgage payment due date, I may be able to use the pre-leave income. Now, the mortgagee must use the borrower's current income plus available surplus liquid asset reserves above and beyond required reserves as income to supplement the amount of the borrower's pre-leave income. Okay, that was kind of confusing. So say the borrower has $12,000, reserves are $4,000. So you have $8,000 left after reserves. I can use that $8,000 prorated as income. The amount of monthly income supplement is the total amount of surplus liquid asset reserves divided by the number of months between the first payment due and the borrower's intended date of return to work. Okay, so again, looking at the surplus liquid assets or reserves is divided by the number of months between the first payment due date and the borrower's intended date to return to work. First payment due date is November 1st. I've got 3 months reserves. They're not going back to work to January 1st. Then I can divide that amount of reserves by the 2 months before that first they're going back to work. All right. Yep, and they are very creative. Mortgagee must obtain a fully executed copy of the final divorce decree, separation agreement, and court order, and voluntary payment agreement with documented receipt. Now, this is if they're getting child support or alimony or any type of maintenance income. Got to have the final divorce decree and separation agreement and the court order, or any voluntary payment agreement, plus the documenting of the receipt of that income.
What if they were never married?
If they get in child support, then it's a court order. So again, if they're not married, this comes when they're not married. Obviously, the only thing that really applies is child support. And I need to have the court order, payment agreement, and proof that they've received it. Typically, that's 6 months proof. If they've received it for less than 6 months, let me know and I will see what type of exceptions that I can make. But for the record, I need at least 6 months. The mortgagee provide evidence that it's claimed or will continue for at least 3 years. Now, the mortgage may use the front and pertinent pages of the divorce decree and settlement in order to showing the financial details. So if you got a 75-page divorce decree, I only need the pages that apply to what we're dealing with. But for the record, that's what I need to be on the safe side. If you get if they're divorced, get the entire divorce decree, separation agreement, and any type of court order payments. Because in underwriting in an FHA loan, when you have anything on there that is weak, you mitigate layers of risk by anything that's strong. So underwriters for years have used that analogy, give me something to hang my hat on. If you got something, if there's anything in the file that is weak, or we have to make exceptions on, let's try and strengthen whatever we can. That's very, very important, especially on a manual. Because on a manually underwritten loan, I have to literally explain why I feel that this borrower qualifies for this mortgage. Because again, DU, while there are things on DU that does matter, it doesn't, that's if you get a refer on a DU, or I had to do a manual downgrade, I have to justify that. So if there's any voluntary payments or anything like that, borrowers receive consistent alimony, child support, or maintenance payments for the most recent 6 months, I may use that current payment to calculate effective income. So that's where that 6 months is. If it's less than 6 months, typically the answer is going to be no. But if you get 4 or 5, I'm going to try to see if I can't make something happen. No promises, but it's also going to depend on any other layers of risk in that file. Automobile allowances, I included this. This doesn't really happen a lot in the files that historically that we receive, but it refers to the funds provided by the employer for automobile expenses. I must verify and document that automobile allowance has been received for the previous 2 years. Again, it's similar to any income outside of your base income. I must use the full amount of the automobile allowance to calculate the income. So if they do get it, let's prove they've been receiving it, and then I'm gonna find a way to incorporate that in there. And the final thing in this part of the deck that I did was expected income. Now, the mortgagee must verify and document the borrower will have sufficient income or cash reserves to support the mortgage payment and any other obligation between the mortgage closing and the start of the expected income. So if they've got bills, they're getting ready to start their job in 60 days, we want to use that new income, I've got to prove that their debt, and it's basically about their debt ratios, that their current income or their current reserves or whatever they have can substantiate their payments until their new job starts. So if their job starts after the first payment date, we've got to make sure they got reserves to cover it. For expected employment income, must verify the existing amount of the expected income with the employer in writing and is guaranteed to begin within 60 days of the mortgage closing. For expected retirement income, I must verify that the amount and that it is guaranteed to begin within 60 days of the mortgage closing. Now, I went through a lot in this section, and I want to make sure that I give you guys an opportunity to digest it. So are there any questions? Let me see, I do see something in the chat box. Who can see the message? Okay, that's just, okay. All right, I don't see. Who can see your messages? Okay, I don't know. That's not a question for me. All right, so we went through a lot, but the key elements are calculating any income other than their hourly rate. Now, in speaking about that, I want to make sure you do understand that if if their hours fluctuate, to beneath a standard 40-hour work week, I have to use the amount of hours worked over the previous 2 years times the new income rate. So they worked 1,800 hours in 2023. They got an increase from $10 an hour to $15 an hour. I will take that 1,800 hours times their new rate. Okay, that is if it fluctuates. So the moral of the story is, give me pay stubs with 40 hours a week, please. But if you can't, just know that we're going to have to prove. Now, I cannot do, and I've spoken about this before, I can't do obvious calculations and divide their W-2 income or their VOE income by the amount of months in a year, given the hours they work. I literally need something from the employer that shows how many hours they worked in those previous years. That is huge because a
Darryl?
lot, I'm sorry.
Good morning. Hi, it's Manuel. Question on the how to determine the amount of hours. How would you determine the amount of hours by looking at pay stubs?
Well, the pay stubs, it'll tell you, when you're looking at a pay stub, it's gonna say, your rate and it say how many hours you work. And I'm adding up, straight hours plus sick and vacation for that pay period.
Let's
So-
say that we got a year-end pay stub, and the pay stub shows, let's say, $48,000, and they're paid $30 an hour. So you would divide the $48,000 by 30 by the amount of the total income by the rate pay to determine how many hours.
Correct.
Okay. So we just have to request a year-end pay stub in order for us to determine the amount of hours this individual worked for that year.
I'm not gonna agree with just, because primarily you want to get a schedule or some sort of ledger from the employer. But with the year-end pay stub, if it is clear with the straight time hours, and the other thing is that you want to make sure that that bar didn't get an increase during that year, because that's going to skew your calculation as well. So typically, I have used what you said, but the patented way to go is a ledger from the employer identifying how many hours that they worked during that previous year. Now, not everyone works for companies that are that that provide that information. So in that case, I will work with the year-ending pay stub. I just cannot use a VOE as a standard and then do the same math with the VOE.
Thank you, sir.
No problem. Good question. All right. Any more questions in that regard?
I think someone's asking about the child support and how many payments would you consider?
As I said, it requires 6, but if you have less than 6, show me what you have, and if we can strengthen it by, if it was payroll deducted or something of that nature, I will see if I can make an exception or get an exception to that. But if they get paid checks and you don't have 6 months, they paying them directly or something like that, then more often than not, no, I will not be able to.
The
But-
situation I have myself, Darryl, is I have a client who has child support garnished from the individual, and she gets the money deposited into a prepaid card. And so
Yes.
what I asked is a copy of the court order and statements that she could print from this website that shows the balance.
Absolutely. That's more than fun.
Thanks again.
No problem.
Deborah, I have a question on piggybacking off of that. So say it's in that statement, right, a separate account, would they be able to use those funds towards down payment or reserves?
If the question was if they'd be able to use those payments as down payment or reserves, if she's accumulated a balance in there, absolutely, that's her money. But to use it as future income to make up the down payment, then no, I can't use it. I can use it as effective income, but I can't use it as reserves unless they have a balance.
Yeah, I had a situation similar like that. I was in a different account and it had the mom's name and it actually had the children's name on it. And a few years ago, we weren't able to use it because they were minors.
Okay, so if in fact now, the question was, what if it's going into an account where it has the mom and the children's name? In that case, as with all of them, we got to verify this is going to continue for 3 years. The fact that it has minors on the account, it's almost like the way I view it is almost like an account with a POD.
Yeah.
So I would make a case to use that income if the mom is the main signer. But if it's other people on the account, and those are the ones she's receiving that income for, then yes. If it's another adult and it's not a POD, then that becomes a bit more challenging. Not impossible, but challenging. All right, another great question.
Hi, Darryl. I have a question for you on the child support.
Okay.
Okay, so I have a client who's getting paid was getting paid cash and she was not depositing. So I have only 3 months worth of deposits into her bank.
Nah, that if she's getting paid and she wasn't depositing it, I can't hit what I can't see in that aspect. So I would have to show, we would have to wait until she has, you know, more, because see, she's manually depositing. We're not talking about payroll or going to a card as the other question was. If it's something where it's a manual payment, you know, that will be harder to validate. Unless, you know, the person who was, oh, she was getting cash, I was going to say the other person can show that they actually paid. But if she's getting cash, then I wouldn't be able to use that unless I had definitive deposits that have to match the court order. The court order can say she gets 500, she deposits 490. And then I say, oh, but this was it. She saved $10 for gas. Well, it wouldn't be $10 for gas in California, but, you know, I couldn't use that. It has to match. You know, I got to be able to draw a parallel line. I don't have a lot of gray area. I don't have any gray area with that. But in your situation, we would need to have 6 months of that.
Okay, that's another question, because on court order, she's supposed to get paid like about $640, but she's actually agreed verbally to only get 600.
And go with a verbal agreement. It's got to be court order. You know, now
So the deposits show only the 600.
Yeah, I know, but see, it's based on a verbal agreement, and that's not matching what the thing said. I'm trying to go back to it. Right here, I'm fully execute divorce. Here it said, okay, now this right here, it says, or voluntary payment agreement with documented receipt. So that voluntary agreement, document that, and then document that receipt. You know, but if the court says that he should pay $640 and he's only paying $600 and she agreed to that, then they need to go back to court and get that amended.
What a signed notary document?
A voluntary payment agreement is not something that has to go through the court. So we do, you know, I mean, yeah, a legal agreement, you know, if it's notarized, you know, of course, that's what we want. I don't want an LOE saying I agree to accept this amount, because then we just got arbitrary deposits and I'm trying to tie it to child support income. We have to draw a parallel line. It does give us a bit of flexibility, and it's right there. Or voluntary payment agreement with documented receipt. Let's not get creative. Let's, you know, use a Sharpie when marking this out. But, you know, if we can make it make sense, I'm going to do my best to make it happen. But we do need to draw a parallel line.
Okay, so if she was getting the correct deposits, in any case, I would have to have 6 months proof of payments, correct?
Right, if it's cash deposits.
And is this for also conventional and FHA?
Actually, I would say yes, because anything that's FHA is transferable. But on conventional, I haven't used voluntary payment agreements. I'm gonna be honest with you. I've never used a voluntary payment agreement. It's been a court order or a separation agreement, and it has to match.
Yeah, if I have the court order and it matches, like say this was another case, I would have to have 6 months proof of payments, right?
Correct.
Okay.
Thank you. Now, you know, Fannie and Freddie, they both have definitive rules as it pertains to alimony, child support, and maintenance income. If there's any ambiguity there where it allows me to use a payment agreement with documented receipt, then by God, I'm gonna use it. But I will allude to what Freddie and Fannie's exact you know, information is on that. But right now, you know, I do want to, you know, go with the FHA route. Good questions. All right. Oh, I'm coming up on time. See, this is the type of thing where I can go on for a while with this. I want to breeze through rental income really quick, because we do get a lot of rental income, and I only got a few pages with this. But before I do, are there any other questions on what we would cover? Keep in mind, guys, send me emails if questions come up, you know, after we end the call. Just please send me an email, and I'll address it as quickly as possible, or you can call me. Everybody knows that. Okay, how do you evaluate rental income? How long has the borrower owned the property? Is the rental income being received from the subject property or does the borrower have a history of receiving rental income from the subject since the previous tax filing? That's now history of receiving. I want to tell you that I do need to see that they're getting the income, at least as a standalone, may not be sufficient if it's not on Schedule E. Mortgagee must add the net subject property rental income to the borrower's gross income, obviously. Use the lesser of the monthly operating income on the Fannie Mae 216, or that's just the rent schedule from the appraisal. 75% of the lesser of the fair market rent by the appraiser or what's on the rental agreement. That's nothing new. No income from commercial space may be included in rental income calculations. Okay, now that's the main caveat there, and hands flew up in the training when this part came up. You know, I've come from New York. Back there, we have a lot of 2-over-1s where 2 apartments upstairs and a bodega downstairs. Person owns that entire building. Based on this, they can only use the income from the 2 residential units and not the commercial space. And that's huge, but we don't see mixed use properties here in California as much. I gotta, of course, calculate rent income averaging amount shown in Schedule E. We all know that. I cannot reduce the total mortgage payment by the net subject property income. So I can't wash it. I can only use it as income. If the property has been owned for less than 2 years, I must annualize the rental income for the length of time the property has been owned. That's common. Nothing new with that. And here's a bit of a grid that shows, okay, rental income from the property being vacated by the borrower. So 1 unit, I need the 1007, which is, the rent schedule. And then the operating income statement showing the fair market rent, which is, normal and customary. I've got to show that it's a minimum of 25% equity in the vacated property. That's huge. Execute a 1-year lease agreement commencing after the closing. Evidence of payment of the security deposit and the first month's rent. And here's the killer. Evidence that the borrower is relocating to an area more than 100 miles from the current principal residence. That's huge. That 100-mile rule is not a lot of flexibility in FHA for that. I know a lot of people say, well, what if they're moving because the crime in their area is going real bad and, there's better schools, or they're moving to care for an aging parent and things of that nature. All hands went up with these questions all across the room, and the instructor, he continuously said, please stick to the 4,000. Please stick to the 4,000. So that 100-mile rule, I didn't get a lot of flexibility there, but I am a sucker for a good conversation. So if you have a situation that I can document, I will escalate it and see what I can do. But by and large, go ahead and get your Google Maps out. The address of the new place or in the place where they're vacating that you want to use as rental income. Let it be 100 miles, please. 2 to 4 units, we don't see a lot of those, but it's the same. It's the same thing. Appraisal showing the fair market value and the residential income property appraisal report. That's pretty common. The only thing on here that should be, somewhat different than you're used to is just that, is the 100-mile rule. And, again, it's not a lot of flexibility, but I have had instances where, it was not just economically feasible, they're relocated because of their job. I had one person who was buying a place in Big Bear. They lived in LA County, and it was only like 70 miles. And they're moving from, residential area to what's considered a more resort area. And they're doing that. They were doing that because, bigger house and all of that. Well, how could I justify that? I had to prove that they were both working remotely, or one person's job wasn't indicative of a location. He worked for the city as an electrical aspect, with power lines and stuff. Whereas he didn't have a brick and mortar location. He could live in Compton or he can live in Riverside. His area is not relegated to one specific geographical area that's far away from where they were moving to. And we got that loan closed. It was one of my test cases, I believe. But again, it has to make sense, but there's not a lot of flexibility. But, you know, again, FHA's goal, and this is another thing that was pounded in, their goal is to provide the ability of home ownership for underdeserved communities and borrowers. So, that's another reason why they feel that FHA loans are pretty much going to be the only show in town, is because, the flexibility that is there, it's not much, but it always leans to benefit the borrower.
Darryl, one quick question on this. So, if I have someone who's gonna be leaving their house and turn it into rental, I do need to show that they have a 25% equity on it.
Correct.
An appraisal on that in addition to the appraisal of the property.
Correct. We need to have a property value report to show and verify that they're going to have 20% equity between when they, the mortgage that remains on that home and the value. Correct.
Sounds good. Thank you, sir. Just wanted to confirm.
No problem. I had chopped out a couple of pages of the actual FHA guidelines, and I did this as it pertains to effective income. Now I went over this, but I did this for a reiteration. And this is the most current edition of the FHA underwriting guideline. Now this is what I have snipped out here. Well, not snipped out, it's the whole guide, but what I have identified here is total, not manual, but total. And this just reiterates what it said before in the guideline, that it must average income over the previous 2 years. If I can document an increase in pay rate, I may be able to use a 12-month average of hours at the current pay rate. Now, this is when hours vary. I will tell you that if I have a full-time borrower and I've got pay stubs that show that he works 40 hours and they got an increase, I'm going to use 40 hours per week times the new rate. Okay, if the hours fluctuate, I've got to use averages. Again, it says right here with the overtime bonus and tip income, just a reiteration, the mortgagee may use overtime bonus tip if the borrower has received it for the past 2 years and is reasonably likely to continue. I started the conversation about on a VOE, it's a handwritten VOE. Make sure those boxes are checked that it will continue, please. All right. If it's received less than 2 years, I can use it if it's been received for not less than 1 year and is reasonably likely to continue. Calculation is just like I said, it's an average of the previous year or previous 2 years or 1 year if I can verify that it's going to continue. It's never the year to date. All right, this goes into seasonal employment. Just a reiteration, I'm not going to bore you by talking about it again. Housing subsidy, we don't see this a lot. This is more geared towards, not that this isn't, but this is more prevalent on VA borrowers with the BH, with the housing allowances. Now, if they do get it, employer housing subsidy refers to employer provided mortgage assistance. The mortgagee may utilize this as effective income, but I got to verify and document the existence of the subsidy. And if they are, but may not use it, I can use it as effective income, but I can never use it I use the term wash, but people don't know what I mean by washing. You get, your payment is $800. You have net income of $400. I can't, in the calculation, just reduce the payment to $400. I have to keep it at 800 and then use that 400 as effective income. All right. So with this one, this is, salary. This is easy. If employees are salaried and will likely continue consistently earn, may use the current salary as effective income. Here's the hourly for employees whose hours who do not vary. I must consider the borrower's current hourly rate to calculate the income. So I'm not using year to date if they're hourly and I can prove they work 40 hours a week. I'm going the hourly rate times 40 hours a week. So really the easy calculation is the hourly rate times 2,080 divided by 12. 2080 is 40 hours a week times 52. So if you got hourly borrower, you know you got 40 hours a week, hit that hourly rate by 2080 divided by 12, there's your monthly income.
Darryl,
Yep.
going back to the rental income for departing residents, would the sellers would have to pay an extra appraisal, correct?
Yeah, in order to use that income, they do want an appraisal.
Okay.
It said that on there, and that's a good question, because on here it says, for one unit for income from the property being vacated by the borrower, an appraisal evidencing a minimum of 25% equity in the vacated property.
Okay. As well as obviously the 261 for the rental.
Absolutely. So, all right, so I went through a lot of income calculations as it pertains to how FHA views it. I am going to, in our last training, I said I'm going to go through income in detail with calculations and whatnot. This was impromptu. Darshan asked me yesterday to put something together, so I wanted to speak in theory today. I'm going to go over the numbers the next time and give you examples with pay stubs, a couple of tax returns, and I'm going to show you how I use my income worksheet to calculate that out. Now, I will tell you that anytime we have we have corporate returns, 1120s, 1065s. We use an industry standard third party calculation module to calculate those using algorithms that have the baked in guidelines for FHA, VA, Fannie and Freddie, and all of those. So I'm not manually calculating those. Now, if in fact my calculations, if I don't agree or you don't agree with those calculations, because it is an algorithm, I can go in and manually adjust things. I just need to substantiate it. But I tell you, income is, improper income calculation is the biggest area of default on FHA loans. And what happens is we'll close and fund that loan. They will review it. They'll spot check a sampling of our loans. If in fact they don't agree with the calculation, they will submit, tiered findings to us. And if we can't correct those, then they will no longer insure that loan. So I say all of that to let you know that income is very, very, very important. I don't have a whole lot of flexibility, but I've been doing this for a long time, and I know where the soft edges are. No gray areas. I know where the soft edges are, and I'll do whatever I can to make sure that we close, every loan that is submitted. You guys are seasoned, so before you submit it if it has a possibility to close. I will tell you, if you're bringing in a file that may have been declined somewhere else, especially an FHA file, please let me know, because I would much rather you tell me, give me the full picture up front. And my ultimate goal is to close it. So don't think that I'm going to automatically hold it against you. I want to make sure that when we close a loan, it stays closed. And I do understand how important it is to not have to go back to the borrower. That eviscerates referrals. It creates, especially if you're getting loans from a realtor and whatnot, that realtor is not going to be sending you more loans if we make it a problematic experience. So if we go in this together, we're going to be able to touch every base and create, residual loan submissions. So
Darryl, I have a question for you.
Yep.
We actually went over this together, and I think it's important for a lot of LOs. There's a lot of clients out there trying to buy 2 units because of the rent, right? So they want to, they're trying to be able to their payment be affordable. And I know we elaborate a little bit on this, which is it could get confusing between conventional and FHA on using the rental income for the second unit as qualifying income for qualification purposes.
Right. Now, the question was using rental income from, if you're purchasing a 2-family, using rental income from the other unit. The key is we really need to show that the borrower has experience in being a landlord. If that borrower does not have experience in managing a property, Freddie Mac for certain, you can't use that income. Now, I have been able to use that rental income from that when I showed that borrower had, had a mortgage before and they're buying this. But if it's a first time home buyer buying a 2-family, they want to use that rental income to qualify, 99.9% of the times, you're not going to be able to do that.
And that's a deal breaker, so I know
It
we
is a
talked
deal
about it
breaker.
a lot, so I thought it was really important to bring.
Right, absolutely. So let's just make sure, guys, if you are originating, a loan where, first time home buyer they're going into and they're buying income producing property, God bless them, because that's going to be more money in the pocket. And it's going to theoretically lower the amount of money that comes out. But if they don't have a history of doing that, I can't use that as effective income. That was a great point.
Yeah, and I think we sent this, we went over the FHA, like Fannie Mae, where it's out of the book, so we can always reference back, because we go through so much that we forget.
Absolutely.
Big right now, I have a few.
Yeah, I have a lot of clients, I come up to you and it's like, okay, hold on, let me remember. Let me
Okay,
refresh.
yeah, whenever you do have clients that have, this buying, multiple units and whatnot, let me know. I mean, we'll go into that. I also, in our next session, I'm gonna be breaking out that deck from my training and going over different parts. I'm gonna go over the condo section with you guys because, condos that's one of those things where in my previous employment, I had AEs who had worked their way to be almost a preferred lender of a whole condo unit. So I have a lot of experience with condos and, with FHA condos as well. And anytime that you have an opportunity to do one, then call me up. If it's before we go through some training on it, call me up. I'll give you an impromptu training. But please, guys, if you have an opportunity to do a condo, let's do it. Let's do it good up front so that we can, move in there and become preferred lenders, because it's a lot of that opportunity out there as well. All right, I'm at time, guys. So if you have any questions that you didn't get a chance to say now, please send me an email and let me know, and I'll do whatever I can to address them. All right. Thank you, guys.
Yeah.
Thank you. Thank you so much.
Thank you.
I was actually gonna ask that, I just didn't.